What's up, guys? Another Trade Genius podcast here. Bob and Phil. Markets went ripping today, but Bob's got some interesting charts that you should take into account. So let's get into that in this video.
Trade Genius.
Guys, really briefly, we're going to do a live stream of the FOMC announcement tomorrow. So you're going to come to the channel, look for our live stream at 1:45 p.m. That's about 15 minutes before the announcement. And we'll stream through the announcement and then the following presser at 2:30 p.m. We'll be streaming all through that, basically live streaming of the charts and talking about the technical analysis that goes into that price action after those announcements, as well as what the Fed's saying to try and give you some interpretation of what the forward guidance is going to be for the markets as well. So don't forget to tune into that tomorrow. Bob, so the market was down yesterday, ripped higher today. A lot of crazy stuff going on. You've been digging into some of the macro stuff. So tell us what is going on as we head into the FOMC tomorrow.
Yeah, hey guys, don't forget to hit like and notification and stuff like that. So it kind of helps the channel. Yeah, so look, I'm really indifferent as to what's happening here in this first month of January because the main show begins tomorrow.
Right.
And right now, the way the market is positioning itself is they're positioning soft landing, Fed pause, Fed pivot. Therefore, ergo, stock valuations are relatively cheap and that the Fed has won the game and basically Goldilocks is back in the house. But the macro picture tells a far different story here. Number one is, before we get to the charts, is that you have a situation where money supply growth is weak, a massively inverted yield curve, and the economic picture is, look, companies don't lay off en masse 5 to 7% of their workforce if things are going great and they're going to continue to grow. And so I'm going to show you first the banks. Now, just remember, we already have the real estate industry on the ropes, number one, and we're rolling into the auto industry, is going to be on the ropes as well. And then we have tech laying off. And now I'm going to show you the banks. This next chart is a wild one. So the banks are essentially borrowing money up to $120 billion now that they're paying and they're losing money on. So they're not taking in interest income at the same level as that they're paying out to borrow money from the Fed, because people are actually walking away from their checking and savings accounts. Number one, it's basically going to pay bills. Number two, they're putting it into higher yielding treasuries and CDs. So the banking industry now is kind of reeling too. And with the budget impasse in place, they have to absorb more and more treasuries onto their books, further curtailing their basically their ability to create credit. And plus, they probably don't want to create credit because probably charts you're going to show later in the week saying they don't want to lend anybody any money anyway. So that's a problem. And now to talk about what we talked about a little bit yesterday, everybody thinks that this market's is gonna basically start turning here because of the Fed being done. But the next chart I'm going to show you here is the way that it's working from a yield standpoint, looking at it from the treasury yield standpoint. So if you notice here, we had a descending triangle that popped into higher yields, and then we're having another descending triangle. The first one was for I believe the August debacle that basically the Fed had to come out and say, I'm dad and you're not. And now we're positioning it again where everybody thinks the Fed's going to pause and pivot. But the expectation is for it now to push up into another level higher, basically changing the range on the 10-year. And the reason why people are thinking this is that, the smartest people in the world are bond people, not stock people. And the next chart I'm going to show you this is how they're positioning short-term money. Okay, so everybody's saying pause and pivot in January and then maybe a pivot in the summertime. The SOFR, which is basically short-term commercial paper market, their futures are saying the short-term money is going higher, Phil, into July before it starts to pause into October. And then we get a steep descent into 2023 all the way through to 2025, which means, i.e., recession inbound. And before I talk anymore, I've been yakking away here. I want to get your perspective on this because I think you intuitively agreed with this, but this is the data here that I'm trying to help people understand. Really, really, really smart people are betting on higher short-term money, not pause money or money that's going to fall in yield. So any comments from your side on this?
No, I mean, I agree. And I think that it seems like, as dumb as it sounds, we're setting up again like we did in August, where market ramps up. Market's trying to call the Fed's bluff. I mean, in August, I think we're having the same conversations on over the internet about how the Fed's going to pivot, right? Or pause this time around. Now they're saying pause. But it's like then he comes in, and I think they're underestimating. There's obviously a game of chicken going on, either by design or they just don't believe the Fed. But I think whatever comes of tomorrow is going to set the tone for quite a while in the coming weeks for the market. I think if Powell's going to preserve his legacy and not become a slave to the market, then he's going to lay down the hammer again, which seems crazy that we're talking about a repeat of August, but I think it might really be that simple. And the way that the market ripped up today makes me think that that is actually what's going to happen, because I'm kind of the mind that if you're going to rip hard into an announcement such as the FOMC, you're probably creating a sell the news event. And so that's my lean going into tomorrow. But I think these macro charts are kind of pointing to that as well as the like the overnight lending that the Fed has, right? We showed that chart a couple videos ago about how the overnight, basically the lending window of last resorts is picking up steam, and we really haven't seen that since '08, the great financial crisis, and from the COVID crash. So those are activities that should have your antennas way up in the air. So I think there's a big push for retail to get into this market, but I think it's a sucker's rally ultimately.
Yeah, we talked about that yesterday too. 60% of activity now in the stock market is retail, and last time it peaked a little bit above that was in August. So the flags are waving. The other thing too is Phil and I we're not monolithic in this stuff. We trade both ways, and in fact, my positioning for my portfolios, I am uber long, but I'm uber long in energy and in gold and silver miners and uranium commodities, and so I'm positioned for that, but I have a massive hedge position on tech and with the bond market too. So just because I'm speaking bearish macro. And now that they can't have it both ways, Phil, now. So if they think they're going to lift this market to a kind of a crack up boom, is that energy and commodity prices are going to go with it. Mm-hmm. And that's going to set up even a worse scenario for both the Fed and for the economy.
Right.
But I don't think we're going to get there. I think I'm going to be spending more time scrambling on hedging my position versus enjoying a crack up boom and dealing with a hedge that may not be working. And the reason why I say that is here's the final thing I'm going to say about the stock market on this is that we're in a position now where the pension funds are flush, and they work off what's called, these risk ratios, right? If they can, I think it's called the Sharpe ratio, if I'm not mistaken, is that if they can perform an alpha, which is outperform their mandate or their peers or their benchmark with low volatility, they'll do it all day long. Well, bonds give you a lower volatility compensation than stocks do. And we're in a position now where the bond yields are set up for going into next year at a point where they can make a lot of money on price appreciation. At the same time, you're getting paid 3-month money. You're getting paid 4.5%, Phil. And so these guys are going to ladder in these bond positions to basically to outperform on their pensions. And there's a $1 trillion transfer expected in 2023 from the stock market to the bond market. And the higher the stock market goes, the worse that flip's going to be for the market when it goes down, because that's even a bigger imbalance for the pension funds and gives them even more room to lock in higher profits going forward. And they're going to do that, especially if they're looking at July being the pause and being positioned for a pivot going all the way into 2025. So we're basically on borrowed time here on what I would call the general stock market. And I'm talking the FANGs, the MOMOs, the high beta, the most shorted. All those stocks are garbage. And if you want to be in the equity market, you're going to have to be in the markets that are looking at hard money, assets versus financialization kind of stocks. So that's kind of how I want to leave it. If you have any other comments, Phil, I'd love to hear them.
No, I think that sums it up. So we'll get ready for tomorrow. Big day. I think it's going to give us a direction for quite a while in the markets after the announcement in the presser. Presser is probably the most important part of that, but we'll be live streaming that and translating what he's saying into English for you guys. So stay tuned to that. We had a pretty good crowd last time we did it at the last rate announcement. Got good feedback. So look forward to seeing you guys there tomorrow. Just head over to the channel, youtube.com/TradeGenius, and you'll see the live link posted there. All right, well, that's going to do it for this edition. Thanks for watching. Please hit like and subscribe. And really, if you could hit that notification bell, that would help a lot. I've noticed we only get a couple to maybe 200 to 300 people actually getting the notification bell. So if you could help us out with that, just helps us out with the algo, and we'd greatly appreciate that. So thanks again for watching. Thanks, Bob. We'll see you tomorrow.
Trade Genius.